the sky.
Good evening, everyone. Hello. We'll get started now. Thank you. Welcome to Brex, everyone, and thank you all so much for being here. I'm Larissa, I was employee number 1 of Brex, and it's our absolute pleasure to discuss how to build your second product with these giants today. Will, co-founder and CTO of Plaid, Jules Maltz, investor at IVP, Kate Clark from TechCrunch. It's great to put a face to our favorite weekly newsletter and the occasional salty tweets. And of course, our very own Henrique. Some of you submitted some questions in advance for our panel today. And one of the most popular ones asked us to explain Brex fast growth. And I'll let Henrique get into detail on that, but the short answer to why we continue to grow is really all of you here today and thousands of other makers who are building and embracing new things, better things every day. It's success to us to continue to serve you guys the very best way that we can with discussions like this one, or with a credit card that will adapt to your company and to your mission. So thank you very much for your support, and I hope you enjoy the panel today. Kate, floors are yours.
Hello. Okay, so we got some really brief introductions, but I think we should get a little bit more from our panelists. So let's just start off with brief history of how you got to where you are. And Jules, I'd like to hear more about what you specialize in at IVP.
Sure. You guys hear me? So I'm Jules Maltz. I'm a partner at IVP. We're a later stage venture fund. We're unique in all we focus on is helping companies that are generally over $10 or $20 million of revenue. We help them scale to hopefully hundreds of millions of dollars of revenue. We're a $1.5 billion fund. We've had 109 IPOs in our history. Our 109th was, we were a very small investor in Uber, wish we were a larger one, but that was today. And we've backed companies historically in the consumer space like Twitter, Snapchat, Supercell, and then a lot of things in enterprise like Slack and Dropbox, MuleSoft. And then fintech's really been a new area of focus for us in the last 5 years. And so we've been really fortunate to back some large companies in that space, including Coinbase and TransferWise. We're a small investor in Brex, very excited to be an investor in one of the fastest growing companies. And we really look for that in all of our investments. There are companies that are going through hypergrowth, where they've really achieved product market fit. Almost all the time we're talking about the first product, so does it work and can it scale? But for those truly special companies, they start to think about product number 2. So definitely not as much of an expert as the operators who are doing all the work, but we fortunately gotten to see a lot of companies go through that journey. So excited to be here.
Hey everybody, my name is William. I started a company called Plaid. What Plaid does is we enable developers and small businesses, hopefully like a lot of you guys, to build really incredible products and financial services. We've been around since, I joke, I've been unemployed since 2013. I think we've been around since 2014 or so, and get a partner with, I met a lot of our customers here in the room, and then obviously partner with a bunch of you guys as well. And thanks for Brex for having us, and Henrique, thanks for inviting me.
Thank you for coming. Is this on?
Just talk loud.
Is this on?
I don't think so.
It's on. Can we use the catch box?
Oh, okay. So I'm Henrique. I'm the CEO co-founder of Brex. And my brief background is that I originally born and raised in Brazil. So a lot of people at Brex, as you can see from the flags behind here, are from international backgrounds. That is, the green and the yellow one. For those who don't know the Brazilian flag, that's ours. And I started a payments business before coming to the US called Pagarment. I grew and sold that business and then moved to the US. Went to school here for a little bit over 6 months, but then decided to leave to come start Brex. And I think, sorry for not having enough chairs. We actually didn't think this many people would show up. So, apologize for that. The next one will have more chairs, but Thank you, both of you, for being here, and thank you, Kate, for agreeing to this.
So Jules, why isn't IVP an investor in Plaid?
Great first start.
I don't know the mic. I don't know. I wish we were. So maybe one day we still can be. But no, I have a lot of respect for what Plaid built. And I think fundamentally what's exciting about Plaid, and we see this in a lot of companies, is that infrastructure layer for an entire sector and an entire movement of companies. I think that's really exciting when a lot of the next and up and coming companies are sort of using that platform for them to grow faster. So I have a lot of respect for what they built. The real answer is we mistakenly said no the first time, and then the second time we couldn't agree on price, but we love the business. So it's an amazing company, and they deserve it. And I think we'll be proven wrong in the end.
But he does much better, and he invests in all of our companies, our customers. So.
Yeah, so we're paying you money somehow.
The 20 bill, we can get a signed term sheet in the back. So.
Well, I appreciate your honesty. Okay, well, I'm sure everyone's curious about how you guys have attracted so much investment and how you've experienced such fast growth, but I think we should just take a step back at first and talk about the core products that have gotten you where you are. So why don't you give kind of a summary of what it is that you guys are doing and what it is your core and debut product was.
You start.
Cool. Also, side note, you feel really stupid with Henrique because we've been sitting here trying to name all of the countries on the flag. I think we got like 50%, and then he got 100%. It was quite annoying. Anyways, on more interesting topics about Plaid. So, Plaid definitely was not a light bulb moment. I definitely, did not wake up in my dorm freshman year and was like, I want to go conquer this. I actually just really wanted to build in financial services. So I think probably like a lot of people in this room, we looked at financial services and thought it's one of the most fascinating markets. It has the possibility to make everybody's life so much better. But routinely, it just makes everybody's life worse. Nobody's ever woken up and be like, oh my God, like financial services changed my life today. Usually it's financial services ruins my life, right? And so we thought, okay, well, we're young, high risk, let's go start something. Let's go start something in financial services and let's go build something. So we went out to go start a couple consumer apps on how do we allow people to, maybe budget better and manage their finances better. And we started to realize that actually the largest problem was actually just getting started, was actually building in financial services. The moment we started actually trying to interact with these old legacy financial institutions, we just kept hitting these walls. So we kind of did what we knew, which was let's go build some infrastructure. So we ended up building this internal infrastructure to how to connect to these banks in a much easier way. And throughout the process, we realized actually what we built was actually much more valuable to externalize than any consumer app we could build. And when we were lucky, this was probably around late 2013, early 2014, in financial services, it was really starting to kind of trickle up and get larger. And we were lucky enough to help a lot of really amazing customers like Coinbase and Stripe, and Square, and Robinhood, and a lot of these guys in the very early days. They were built on Plaid, and we got to scale up as they grew up and help power kind of this new generation of financial services that's really changing the way we think about money.
So Brex started because when we were in college, we decided to get into YC, and when we actually got into YC with a very different idea. We got into YC with a virtual reality idea, and our idea was to build external monitors for VR. That's the first version of Brex. And then, within YC, we're like, hey, this VR thing is actually really tough. Like, I don't know anything about this. But, we had built this payments company before, so we kind of went back and, okay, let's build something in payments. This VR thing seems really, really hard. And we saw that a lot of startups, they had really bad experience with credit cards. So they always were like, hey, either they couldn't get a card if you were international. So, for example, we had raised a bunch of money and we couldn't get a card. That didn't make any sense for us. Or if you were willing, you could personally guarantee, but then you wouldn't get as high of a limit, and you have to put all your personal assets in line. And we thought of and plus, the experience was horrible. The dashboards didn't work. It was hard to do everything. So we thought, hey, why not build something better for startups in which you don't have to personally guarantee the card, and we can give you, higher limits based on how much money you've raised and your investors and all of that. And things that are very specific for, the first vertical which we chose, which was startups. So that's kind of how I started. So, an overview for those who don't know, we do, corporate cards for startups and e-commerces now. And as I said, we can give you high limits, no personal guarantee, very easy to use products, and for all the customers in the room, our full receipt texting matching functionality.
So why is it called Brex?
So I wish I had a better story for this, but I'll tell you the real one. When you're in startup world, we read a program essay saying that you would need to own the .com domain. And we're like, okay, we need to own the .com domain. But everything that we could think of, .com, didn't have the domain. So we went on this domain marketplace and started thinking of seeing like the domains that were .com available, and started reaching out to all the ones that had 4 letters. And Brex was reasonably priced, so that was it.
Okay, so Brex has now raised more than 200 million in equity funding. Plaid's raised more than 300 million at a 2.6 billion valuation. Brex at a 1.1 billion valuation. Jules, I'm curious to hear from you what it was about Brex that made you want to invest, and what it was about Plaid that made you pass.
I feel like I've been as honest as possible. Now you're to be candid. So I didn't lead our investment in Brex, although I'm supportive of it and very excited we're an investor in it. So, but I think this job, the investing job, is so, I don't want to say it's hard because you're no one feels bad for investors, but it's it's so hard. But it's very humbling. You're wrong a lot, to the point where I have nightmares about meeting Travis at Uber when the company was worth $300 million and not realizing that I should have invested at that time, or Zoom, and so I literally, these things kind of haunt you forever, and the successes. So I think the first thing about this job is that it's just, you're wrong a lot and you have to be comfortable with that. I don't think I'm totally comfortable with it, but I've gotten to the point where I've done it long enough that I am where I am. But there are so many tremendous businesses that we meet, and honestly, it's really about just the fit, and is it the right time, and do you believe, and is it, and some of it is actually just, is it, that fortuitous timing, and and you had a good breakfast that day, and you came into the meeting enthusiastic, things that investors probably don't honestly talk about, but sometimes the timing works and sometimes it doesn't. And I think with Brex, what was really clear with Brex is just, they still have massive market pulls. So there are just startups that cannot solve this problem, that need this problem solved, and Brex has the product that solves it. And so they have true organic traction, which is super unique. We just don't see that. Whenever we see that in the consumer space.
Plus all the billboards.
But you weren't spending that much. I think that's what's interesting. It's it's not it's not like some companies' marketing is 90 or 95% of their acquisition spend. I mean, there's billboards, but they're not, there's customer love. And I think that's really clear. And so whenever we see that, we know something's really special. And I think the thing we were wrong on with Plaid is that when we first met, it was a couple customers that were really a lot of the revenue. And what we didn't foresee is this wave that it's not just a couple innovative fintech companies who need infrastructure. It's all of the innovative fintech companies, and there are hundreds of them, and they are big, and they will matter. And I think that's where, that in the last round especially, what Plaid really proved out was that this is critical. It's like Twilio, it's like SendGrid. There's a whole movement of companies that'll need this infrastructure. So, but yeah, being humbled and then having to talk about it in front of everybody else is it's hard, but I'm used to it. So.
Well, I appreciate it. Thanks. Okay, so you brought up the billboards. So now I have to ask, why so many billboards? And Plaid, where are all your billboards?
Do you want to go? Do you want me to go?
I'll start. So for us, the way we think about marketing is, in the end of the day, American Express has, a larger brand than Brex, right? There's been spending billions of dollars for many, many, many years building their brand, and, same thing with all the big banks. So we thought about how can we compete, and we were like, okay, maybe we can compete on a global basis to know, American Express and our brand there, but maybe we can beat them at least in startups, And the idea is that a lot of startups are in San Francisco and the Bay Area, and all the VCs are here, and they go there, talk to Jules in the financial district office or in Menlo Park, and all of them are here. And then we're like, okay, so maybe we can win the brand war of America, having a very strong brand within our vertical, and a lot of startups are in San Francisco. So the way we thought about it is, how do we have our awareness be super high within this specific vertical? And billboards in San Francisco were one of the things that worked the most. And the thing about billboards that most people don't know is that they're individually very expensive, but as you buy a lot of them, they're not that expensive. So the first billboard campaign we did last year, we probably spent something like $300,000 over 4 months of taking over San Francisco billboards. Which, it's a lot of money. I'm not saying $300,000 is not a lot of money, but, that would be not that many clicks on Google and Facebook. So it was completely worth it for us.
Yeah, I think you just need to be introspective on, as a company, where do your strengths lie? I definitely do not come from a sales and marketing background. I very much come from kind of the engineering and product land, and that's really where we focused our time and effort. We have a very small sales team. We kind of a non-existent marketing team. We drive most of our volume from developers just kind of hearing about word of mouth, knowing Plaid in the market, and just signing up. I think, San Francisco is actually, I think it's less than 25, 30% of our revenues from San Francisco. So I don't think there is as much of a concentration to drive. I think, the great thing about Brex, which I'm very jealous of, is pretty much everybody who has an office in San Francisco is a potential customer. That's not the case for us. I think hopefully everybody who's building financial services should be a customer of ours, but they're not.
So it seems like Brex will reach a point where they've kind of tapped into as much of the startup market in San Francisco as they can. So how do you think about scaling beyond San Francisco? And do you treat these different markets that I'm assuming, are looking at as new products themselves?
So for us, and going into the theme of this thing, for us, different verticals are different products. And the reason for that is, the thing that Brex did the most right, and, that we fundamentally got right, that a lot of people underestimate, is we didn't pull all SMB into like one big bucket. And we're saying we do this for SMB. Because the reality is, like, not a lot of people want to be SMBs, right? They're restaurant owners, they're, startups, they're hotels, they're e-commerce companies. And that's how they identify. No one is like, oh, I'm a small business, and I want to keep being that. So for us, what we did is that when we go into a vertical, we adapt our product a lot to that vertical. So for startups, what we found out was the underwriting model based on cash makes sense because startups raise a bunch of cash. Not having a personal guarantee and having high limits matter, but having really strong rewards really matter. Giving people a lot of points, on their software spend or their ride sharing spend and all of that. Giving people, AWS credits really matter. But if I go to a restaurant and I say, hey, you get $5,000 of AWS credits, they're most likely, unless they're in San Francisco, going to say, what is AWS, right? So that's why we need to have these kind of like specific product. And product for us is not just a dashboard. Product for us is all this part of the offering, right? But then we go to e-commerce, which is our second product. E-commerce companies, the one thing that matters the most for them is cash flow. For them, having the working capital to buy inventory, buy advertising, sell that inventory, get the money back and restart the cycle is the thing that matters the most. And, they care way less about points and way more about that. So for them, we did, the 60-day kind of product where you swipe today, you pay 60 days from now, you swipe tomorrow, you pay 61 days from now. And that for us is a different offering, therefore a different product, even though it's a card,
When you say e-commerce, do you mean you're going after really large e-commerce businesses or you're going after smaller e-commerce companies?
Well, it depends on what your definition of large is.
What's your definition of large?
I would say most of our customers are sub 150 million of revenue.
Okay, and William, for you, do you treat entering new markets as new products themselves, or how do you look or consider the scaling process for Plaid?
Yeah, no, it's a good reason. I think, second product is kind of a wavy definition, but I think for us, at least when I was walking over here, we have to understand like what does a second product mean and like why are we doing that? Are you doing that because you are facing commoditization of your product? Are you doing this because you want to make more revenue? Are you doing this because you see competitors who enter new verticals that could potentially move over? If you look at commoditization, it's like analytics startups have had a hard issue with this, right? I think analytics startups in the Valley ship out new products faster than anybody else. Or cloud providers, right? AWS are just like expanding their dashboard like nobody's business because their core products are somewhat commoditized. I think for us, we have kind of one or two really large products that drive a vast majority of our revenue. So as we think about new products, they're less of, we're going to go to a new country. I think that's part of our core products. It's more about like small iterative improvements. And so can we build actually a new product on top of something we've already built that can then enter a new market for us? For example, like our core products historically of how do you actually pull transactional data from a bank? How do you do payment verification from a bank? The newest product we launched late last year was a company called Assets, which has allowed us to verify a user's underlying assets for mortgage underwriting or alternative lending underwriting or something like that. In the end, all it is kind of a wrapper on our core two products, just with a couple other features on top of it. And so for us, really what we're doing is we're trying to figure out how do we take our existing products and enter a new market that maybe doesn't understand our core products. So is that a second product? I'm really not quite sure, but it just allows us to expand horizontally.
So building and launching a sophomore product is a really pivotal moment for a lot of companies because it's sort of proving that you can scale beyond that initial product. So I'm curious, Jules, what kind of advice or how do you help your portfolio companies that are at that stage, that may need some additional support? How are you most helpful at that point?
Yeah, I mean, I guess the first thing I'd say is like it's really hard to get one product really, really working well. So I think too many times like there are no points for like you've launched 4 products if none of them are really growing super fast. So I think the focus should be on do you really have product market fit? And you'll know you have product market fit when you have customers coming to you organically, when the sales motion that is a really efficient sales motion. You can hire salespeople and those people become efficient very quickly. You'll know based on the customer feedback you have, are they happy with your product? Are they churning? So I think if you have that successful first product, I think that's where most of your resources, almost all your resources are going, and you're trying to drive that as quickly as possible. The great companies start thinking beyond that first act though, because they know that in any successful product, there's going to be some ceiling to it, whether even if it's Facebook or Uber, you're going to have your market size is going to have some constraint. And so you need to be thinking about what else you can do with the distribution and customer base you can do to solve more of their needs. And a lot of that, I think, should come from the customer. What are the problems that your customers are having? Or are you finding, some of your startups are e-commerce startups. And so what are their needs? How are those different? And then if you can build a new product around that, you can drive faster revenue growth and also kind of build the muscle of like, great companies aren't kind of one trick, product or pony companies. They're ones that have this muscle of they innovate, they build new stuff, they serve customers. And I think it's a really important muscle, but start with that first product, get that right, and then you sort of earn the right to even be able to think about a second product.
But once you do have multiple products for the CEOs, how do you guys make sure that first product you built, the one that you've developed a reputation for, is still as great as it always was? Like, how do you balance, where you're investing your time and your resources as a company once you have a whole portfolio of products?
You guys want to? You can take it.
Okay, I'll take it. I think for us, it's anything about prioritization. I think what can happen, which I think we've all probably seen too much, is I think companies probably expand way too quickly on their product portfolios. I think Jules is right. Like vast majority of big companies usually have one product that drives like 99% of the revenue, right? If you look at Twilio or even AWS or even Facebook or Google, you have these monster products that drive everything else, and then like 99% of your engineers are working on like the next generation of products. I think sometimes that can be a little dangerous because your core product is really what is driving customers to you. And so making sure that you balance the need to kind of, get the sexy new product, but also investing in the core. And that is really hard. I think, manage engineers or sales teams or something like that. Everybody wants to work on the new shiny toy. Everybody wants to sell something new, right? And so it takes a lot of motivation, a lot of internal planning to make sure but you don't let the old products start to kind of wither and die. I think a lot of reasons on probably why Henrique and I are even around is because, we're not the first people who started a corporate credit card or the first person to think about building developer financial services, right? Is there were companies before us that got kind of old, they got kind of lazy, they got excited by new things, and they really forgot about who they really were and what the core value that they were driving to customers were. And so it allowed us to kind of swoop in behind them and really out-innovate them. And so for me, I'm actually even more thinking about how I can make sure that core product is being invested in, less than what am I going to do next.
Henrique, could you use Kate's microphone, please?
I feel that my opinion, if you're gonna build a second product early on, a lot of the times the best way is having a second product that helps your first product. And because you built that second product, your first product is better, if that makes sense. And I'm trying to think of a good example. So give banks, for example, right? If a bank is lending you money, somehow by having a bank account or by having other lending products, it's easier for them to underwrite you, let's say if they have your bank account, right? Because, your money is there, so, worst case scenario, they can take your money, right? So, that is an example of something that banks do, or, for Facebook, or Amazon is a good example. Amazon builds a lot of small business products that help small business succeed, and then they end up buying more from Amazon. So I think that, if you build a completely separate product that doesn't help your initial product, it's kind of harder. But if there's a virtuous loop of when the first one helps the second one helps the first one, it can actually make both of them more powerful instead of competing with each other.
How does that apply in your case? Sorry, I don't know if this was. How does that apply in your e-commerce versus the startup?
Our case is a little bit different in the sense of there's only 70,000 startups in the US. So, for the size of our ambitions, we need to expand outside of it. So it's more, we can't survive just by serving startups as a company. We need to expand, but it was a great kind of first product for us, and it's still growing really fast, but the size of our ambition doesn't allow us to just stay there.
And just an FYI, we will take questions at the end, so I'll make sure to leave plenty of time for everyone to get their questions in. But I'm curious, do you guys ever find, when you're meeting with your other executives, you have to remind yourselves, okay, we can't, growth at all costs and extremely hyper fast growth is not ultimately going to pay off if you're not careful and thoughtful about building your products?
I think it's super market dependent. We are not a raise a ton of money, blow through it really quickly, and grow at all costs, because our market doesn't really if I raise $1 billion, I don't have $1 billion worth of things to spend it on, right? I can't turn that into $1 billion in revenue, right? Because the startups in our business are building in financial services, and it's going to take them a couple of years to scale to find product fit and really scale up from there. And so I have a little bit more of a slower business. I think if you look at Uber, right? If I was running that business, I would also probably dump, $10 billion into that, right? Because it's a land grab. It's purely a land grab. Your core product is somewhat commoditized, and it's who can get to that market as quickly as possible. So I think you just have to look at yourself and be like, what type of business am I in? Can I turn cash into revenue? For me, probably to a lesser extent than Brex, Uber, or something like that.
The way we think about it is, it's, as you said, very market dependent. I think some markets are winner takes all, right? And for those markets, if you're not the winner, you lose all, right? And for those type of markets, I think raising a lot of money and going as fast as you can, having growth for our cost, is not an option, it's a requirement. Because if you don't do it, someone will do it. In our market, we do corporate credit cards. There are probably 50 companies in the US that do corporate credit cards. And there are 44 banks in the US that are over $10 billion in market cap. So think about this, right? There's 44 companies that do exactly the same thing, and they're all over $10 billion in market cap. That just means this is the complete opposite of a winner-takes-all market. So we, not Uber or any of the food delivery companies, they don't have the luxury of being able to go slower. We can do that. And I think similar to Will, we can't transform $1 billion into $1 billion of revenue, but because we lend money, we need to be very balance sheet heavy, if that makes sense. So even if I don't spend the money, I need to have the money, because otherwise, all these banks that we work with on the back end, or all the customers, like, what if you just blow up? And if we don't have a lot of cash reserves, it's dangerous to grow the speed we are. So we're always going to raise a lot of money, but a lot of it to keep in reserves.
So Jules, if he came to you and said, a SoftBank's offering me $1 billion, what would you tell him to do? Sorry for all the hard balls.
You're getting the worst.
Luckily, I don't have to. Yeah. I think it's fine. I mean, I think capital is a double-edged sword, right? Even though I'm kind of in the market of giving capital to companies, actually, I worry about companies taking too much money too early. For a little bit, the reason that William was talking about is that it's hard to find the real use cases for it. And I think there's just something good about the discipline of not having unlimited of everything. A startup that. I like this idea of we're running a business here, and that we're going to make business decisions, and we're going to make investments in new products and in people, and those are going to have a return, and those need to have an ROI within a certain amount of time period. We're not going to do things that don't. We're not going to have unlimited kombucha in the office. 1,000. Maybe you guys have kombucha, but good. Okay, but we're not going to.
I love kombucha.
We're not going to have 10 kinds of kombucha. We're going to run a business, and we're going to drive results, and that's going to be really important. And if kombucha leads to results, I'm all for kombucha. But
I can turn kombucha into
but so I actually think sometimes money's not always the best thing for startups, and I think especially in the fintech space, I think just a word of caution is, and we saw this a little bit with e-commerce. There was this big boom, and everything was e-commerce, and their valuations of e-commerce companies were kind of off the charts at one period of time. And then people realized e-commerce is kind of a lot like retail, except it's just online. But we're selling goods, and those goods have costs, and some of the same dynamics. And I think with fintech, people are starting to realize in certain sectors, hey, fintech is financial services. And yes, technology allows those financial services to scale way faster than other things. But ultimately, you may be a public company, and you'll be valued on PE, on your earnings, and on profitability, and what those long-term metrics are. And so having a mind towards this is what we're driving to long-term in the business, which does not mean you cannot be super aggressive and grow very fast in the near term. We've seen Stripe do that. We've seen Square do that. But ultimately, you're driving towards long-term profitability and massive scale. And so I just think having that discipline from an early stage is critical. And so if a company says, hey, I've got this investor at $1 billion, I don't think it's an easy call. I think it's something you got to think really carefully about.
So just one thing to add, the thing I found super useful to having more money earlier on was just being able to pay people well. I think as a startup, a lot of times you're competing in this extremely competitive market of talent in San Francisco. And you end up, trying to get people and pay them not a lot of cash because you want them, bought into the business. But the reality is that San Francisco is this super expensive place. And, a studio apartment is $3,000 a month. So I think from very early on Brex, we decided to pay people very well. And I think we wouldn't have done that if we were more cash constrained. Versus, because we always were well capitalized since very early on, we're able to attract a lot of talent. Obviously, I think a lot of them are here for the mission, but comp enables them to come here. And I see a lot of startups missing out on great people that were willing to go because they can't afford to pay people well.
I agree that. I agree with that to an extent. I think the one thing that we've realized a bit is people join startups for different reasons, and why those are all okay in their own right. Some reasons are better than others. The best employees that we've had actually did not join because of a high valuation, did not join because of money, right? The best startups joined early on because like they wanted to hustle, they wanted to grind, they wanted to learn, and they wanted to be part of something big. And even now, like, we have a lot of cash, we have a high valuation, and it makes recruiting easier. But sometimes the people you hire, like, they're there for the wrong reasons. Like, like if I'm competing with Google, if I'm competing with Facebook, no, like go to Google or Facebook. You're in it for the wrong reason. This is not a 9-to-5. We're not a big tech company. Sure, we have a large valuation, but you want to join, be part of something larger. And so while cash definitely does help, it can also sometimes attract the wrong people.
So as I've said, you guys have both raised hundreds of millions, but I'm curious what it was like for you raising that first check, and how difficult that was, in those early days.
It's like going through a meat grinder for years and years, and begging Jules to give you money, and then rejecting you and rejecting you and rejecting. He only rejected us a couple years later. Just kidding. I love you. This is payback.
I know.
I think actually to Henrique's earlier point, I think there is somewhat, maybe I'm being too reductionist here, but there is some sort of correlation between successful startups and recessions or a hard time raising money. If you look at Uber, if you look at a bunch of these companies, a lot of them started in the recession. A lot of them started in a time, and Facebook as well, started in a time where capital wasn't as cheap as they are now. And I think that creates a sense of discipline, that creates a sense of hustle that some companies, don't have if it's super easy for them to raise money. My co-founder and I, we actually, we technically started a company in Atlanta, and then moved to New York. And we didn't do any of the incubators and do anything like that. We weren't really name brand founders. We were 21, and it was brutal. It actually took us 2.5 years to raise money. And the only thing we did was raise two 12K checks from some hedge fund bros who just like got their bonus and wanted to blow it on some like startups. And like, I love them, but like, they're not smart money. And I was like, please give me your money. And that created.
This is being live streamed, right?
Okay. Oops. Sorry if you guys are watching it, Justin. It's a good investment for them. But it was hard, and I think it actually created a really strong sense of discipline. Sometimes we probably have too much discipline, but for 2 years we didn't hire anybody. We couldn't raise any money. I wrote all the code. My co-founder did all of the sales, and it was absolutely brutal. And I think we are definitely not a hyper-growth startup now, but we really didn't hit that until 2014, 2015. So for us, it was really, really rough. And so all the founders who have pitched 60, 70 VCs and gotten rejected, like, been there with you. It sucks. Keep going. And it was really hard. But, it creates a nice, healthy skepticism for VCs and a really good grit. But IVP is one of the special ones.
So for us, it was, I would say the two companies that I built was very different. The first company, we were 16 when we were starting in. I can tell you, there's not a lot of VCs willing to fund 16-year-olds in Brazil. And it was like kind of a grind of like, we were, hustling a lot, and we raised $300,000, and that was the only money we raised throughout the entire of the company. And to be honest, the $300,000 there would be like something similar to like maybe $1 million here. But that, I think, building our first company in Brazil created this discipline of like, one, there was no Series B money. I don't think IVP does anything in Brazil. So you had to be profitable. Like we were profitable after like 1 year of operations because it just wasn't an option. And there was a month in which we didn't grow enough to make the payroll, and no payroll we made, but then we had to ask all our suppliers to wait a few months before charging us. We were sending some invoices because we had to make some more money. And I think that created this discipline around just being very thoughtful. Like after a lot of our investors they were very worried because Brex raised a lot of money very fast. But you ask them today, a lot of them were like, well, okay, it seems to be going okay. You guys didn't get a lot of kombucha, and decided to go crazy. And that comes from the discipline we acquired from, building that first company in Brazil. But then after we sold that company and came to Stanford and came to Y Combinator, like all these things, they're kind of like a line of credit, And over your life, you do a bunch of things and you get this line of credit. And I think our first investment, if we were doing VR and then we changed to payments and people were still, willing to invest in us. And I don't think that was because of the startup we were doing per se. It was just that we by being a second time founder and having done something, relevant in Brazil, we got this line of credit, of credibility that we were able to raise our first round on. So, for Brex, I did, and I say this to be the most transparent as possible. I wish I had this like grinding story for Brex where I could say all the VCs told no to us, but it's pretty much the opposite. Everyone told yes to us and it was very easy. But again, that only came because it had been, 5 years grinding and trying to build payments company and, making that one work. And then, we got this credibility of, someone was willing to give us a couple $1 million without thinking about it, but that's just the truth. And, I wish I had a better story, but.
Jules, do you have any fundraising tips for the potential entrepreneurs in the room looking to raise money for their startups?
Yeah, no, I liked the idea. I think we really try to have a lot of empathy for entrepreneurs. I think that's we wouldn't be in business without them, obviously, but it's just, it's an incredibly insane endeavor when you think about it, right? To go start this thing that needs to exist in the world from scratch, that everyone tells you can't do it, and you persist. And so I just think like we have a lot of respect for entrepreneurs who do that, and you need to find your people in venture that connect with that idea, and it's not going to be everyone. So it might mean that you meet 60 people, or it might mean you meet one and you find it immediately. But it's just staying true to what you ultimately see in the world and why this needs to happen. I think that belief is what's going to keep you going through. I do think that too often people focus more on like how to hacks for getting venture capital, and how to do slide decks perfectly, or what to say in the meeting, or should I talk about, and I have those too, so email me later or whatever, Jules at IVP, if you need like those hacks. But more important than those are like, are you building a good business? Like, and this is why I think we do later stage, but have you built a product that customers connect with? Have you done research? If you haven't even launched your product yet, how do you, what is giving you that confidence it's going to work? What's your experience and authenticity in the space that leads you to believe it's going to be successful? Who have you recruited, and how have you gotten a team on board to also believe in your idea? And so actually the what you are actually doing and the business is more important than how you present it a lot of times. And so I just think focus on that, and then eventually, even if 30 people say no to you, you build a good enough business along the way, like someone's going to pay attention and it'll happen. And try to block out all of the other startups raising hundreds of millions. Like, I feel like it's got to be super depressing to be in the audience. You're like, here are these amazing entrepreneurs raising hundreds and hundreds of millions of dollars, and it's like, it is hard, and you have to almost block it out and just work on your thing and hope it works and go do it. So good luck.
I think the one thing, if I'm going to kind of postmortem my own process, is we got in this mentality, I think I see a lot of other entrepreneurs do as well, as like part of starting a business is raising money. And I think that's like totally dumb. I mean, I started a business, we ran it for 2 years on like 15K each. Granted, we were lucky, we had like free places to stay on our friends' couches and stuff like that, but you actually don't need to raise money to start a business. I think if you look at a lot of like the really great fundraising rounds recently, it's like GitHub, right? It's like you had Andreessen put like $100 million into a company that had never raised money for like 10 years. Like, those are the businesses that I'm sure IVP wants to invest in. Is how do you actually bootstrap a business for a long time? And then when you figure out how to turn dollars into revenue, then go talk to IVP. I think like 90% of the businesses that are out there like raising these like, 500K seed rounds, like that doesn't need to happen. You don't need 5 people to be a real business. I think 90% of the time it's like early founders who like want that check on their resume to be like, I raised money, and like it's an ego thing. Most people, I don't think, need to raise money for a very long time to raise their businesses.
I think that's specific for engineering co-founders, because if you can't code, it's kind of tough, right? Too.
I disagree. I think
How did you
I
figure out
think
coding?
it is so easy to build businesses right now in terms of like the software stack. Like you don't need to write like low level infrastructure from stack. You can like honestly, you can start a fintech business, plug Plaid, a couple other things together, and like you have like a pretty decent business. Like most businesses aren't hard, complex engineering problems. If your business is a hard, complex engineering problem, you're probably doing something wrong. There's always edge cases. There's a ton of examples that can prove me wrong here, but I think for a lot of people, they don't need to do that.
My fundraising hack, so I think all of you want a hack, so I'll give you one. Is I think like a lot of people, they meet investors and they're immediately like, it's like, oh my God, this guy can give me money. Let me try to get some money out. And the biggest thing that I learned over time is that the best way to raise money is just build relationships with people over some period of time. And they'll get to know you, you get to know them. And then eventually it will make sense to do something together if, they like your business, you like them, and, you'll agree on terms and do something. I think that, a lot of times people go on these like fundraising processes, and they're meeting a lot of people they never met before and asking for, millions of dollars. And at least in our experience, it worked much better to get to know people before over a period of time. And then at some point when it makes sense, you get something done.
Are Brex and Plaid fundraising right now?
No.
I think with any startup, I think to Henrique's point, right, is like to an extent you're always fundraising. I think unfortunately money is like VC is a little bit like heroin. Once you take it, you got to keep doing it, which like it sucks. I wish it wasn't like that. But I think you should always be in a mentality of like, you do need to make sure you have good relationships with VCs. I think the reason that like, Henrique and I can fundraise without trying super hard is because we do have relationships, right? It's like, Jules is amazing. Like he's a friend. We can all talk, we can hang out. And when it needs time to do something together or when you need money, it's a pretty easy process. Because the worst thing about fundraising is if you end up spending like 3 months full time and you like forget about your product. And so when you do want to have money, you just want to make a couple phone calls and just get it over with.
Yeah, no, I think that's right. The other thing I would say is, people all that, like, we meet, there's two things. Like one, VCs always ask us like, hey, when are you going to raise money again? And I never know the answer. For us at Brex, we never associated our cash needs to raising money. We always associated when was the right time, the right person, and the right price. And if you can get those 3 things to combine, you don't have to raise a lot of money, but if you start taking the heroin, those are the good times to do it again. So I agree to some extent. We're always fundraising, especially as these late stage businesses. But the other thing I would say is at least we always met with VCs, and my main thing is like we serve startups. They invest in a lot of startups. Get me customers. So depending on your product, you can also use VCs to do some work for you, and the good ones do so.
So when you are ready to fundraise again, how different will the process be given you have all these markets under your belt or all these customers under your belt, additional products? And same question for you. How has that process changed for you? I mean, in addition to what you just said about having people you can essentially call and be like, hey, do you want to invest in my round?
I mean, late stage fundraising, it's a completely different sport than early stage fundraising. Like there's very little correlation. I think if you actually need to raise money, you're doing something wrong, and you're probably going to get screwed on terms. And so I think that's why when I was fundraising, right, is hopefully there's like some information disadvantage. Is I can tell Jules that I actually don't need money. They're like, maybe I think I do in like a year, and like there's some arbitrage there. But I think it is just completely different. I mean, no VC should ever like reject Brex, right? It's an incredible business. Like the main things like you're just gonna argue about is terms, is price, right? And so that's usually where most of the negotiation goes. When you're early stage, you're just like, oh my gosh, like please give me money unless I'm gonna die. So it's a little bit of a different story.
I think you feel you have more to add to that than me. So.
Oh, I
think fundraising becomes very different at the late stage because it's more about metrics, right? It's more about, do you have a repeatable business model, sales model? How are your unit economics? Are you measuring lifetime value to acquisition cost? And so I think it becomes a more metrics focused discussion. A lot of times people use the same pitch for the Series B as they use for the Series A, which is often a mistake. The Series A pitch is, the vision and the market and some early traction, and ultimately, the B pitch is going to be like, show me your data. And that too, I want to hear the vision too, but I want to hear the data equally along with it. So I think some people make that mistake. One of the interesting stats sort of reminded me, about it is that, for the average company we invest in, the average time that we have known the CEO before we invest is 20 months. So we're often getting to know companies quite a bit early, and that data is really important to us because it allows us to see, did they do what they said they were going to do? Did this person deliver? Did they overpromise? How have they tracked? How have they grown his or her team? That's really important data points, and it also allows them to get to know us. Because things that Henrique was saying too around, did they make customer intros? We always say, hey, what can we help with? And we ask that really honestly, because what we want to do for the best companies is when they say, I'm looking for a VP marketing, we want to send them 5 ideas, and hopefully those are good ideas, and they think, hey, when I'm raising money, IVP can be someone
Well,
actually
you got
delivers.
Azor, so thank you.
So
Did we do? Yeah. Oh, well, yeah. Yeah, so I think that's important.
Yeah, I think, what, the only thing I would add is like, a lot of times people say is like, the late stage is about metrics, the early stage about team and vision. I feel that, it's always about both, if that makes sense. But I think that your metrics should just be a way to prove you're on the right track for your vision. Because if you just get too much in the metrics game, like you're not going to get good terms. Because then, you're never, startup multiples are not public company multiples. So it's never going to make sense. And, you're growing much faster than all the public companies. So I think it's very important. It's like, I feel that, a lot of founders, they know what they're doing today, and then they know what they're going to be doing 10 years from now. And they have like, that mission or vision, but they have no clue of like how to get there. And then they rely on just metrics to see, hey, this is like, I'm growing fast, and this is my CAC and my LTV versus CAC, and like, they get stuck in pitching like all these metrics, which for me, I think it's a little bit of the appendix. I think, just to prove that you're on our way there. A very important thing to think about as your company is scaling is like, okay, you're here, you're going to get here. What are the steps that someone can understand how you're going to get there reasonably? And then use the set of metrics that's going to prove that you're on the right track to get there, instead of getting over obsessed about the metrics or over obsessed what's the 10-year plan.
All right, well, there's plenty more we could get to, but I want to take a break now and just see if there are questions before before I move on.
That's a startup right there.
So this is a question for both Brex and Plaid, but are there any kind of big moonshot goals that you have that maybe wouldn't be so obvious just from kind of looking at your website?
I think we both probably tend to be fairly secretive companies, and so now that it's live streamed, I'm not quite sure how much I can say. But I think, I think for us, I think if you look at Plaid, you look a little bit like, it looks like an aggregator, right? It's like how do you take information from the bank and give it to developers? I think with everything, like that is an entry point to a larger mission for us, right? Is we want to change the way consumers and developers think about financial services. Like we have a long-term goal of being a completely new financial network that actually empowers consumers to control their own data. So I have a vision that, when you're a small business and you are going to go sign up for Brex, I don't want you to hook up your SVB account to Brex. I'm going to hook up your Plaid account to Brex, right? Because I want to be that financial hub of your life that you're going to connect to many, many things a week and a day. Obviously, if we're far away to do that, like we have to be an aggregator in between. But I view where we are right now as a step in a multi-year journey.
I think that,
He's going to say the same thing, too.
I feel that what we're trying to do is that we're trying to rebuild B2B financial services, and we think corporate cards were broken, and we're fixing that, and that's the plan for the next couple of years. But we believe that there's a lot of other products out there, and we don't know which ones exactly yet, that are also broken, and we can use the same kind of strategy we use for corporate cards, this rebuilding all the technology from scratch, launching this vertical by vertical strategy that we can go into the future, and fix financial services for businesses.
We're just waiting until finally Brex can buy American Express, and so they can fix it.
Oh, no, yeah, yep.
Oh, cool. Hey, first a comment, then a question. So I run a B2B SaaS. Our employees have been asking us to set up a 401k. I go on the rewards, and there it is, $500 setup fee waived from guidelines. So thank you for doing that. That's awesome. And we use Gusto, so it's easy. And the question is, we, of course, do NPS on our customers. We're thinking about doing employee NPS. You guys have obviously a lot more employees than we do. Are you guys doing employee NPS? And what is the metric you go by? What's the score? Like, what are you looking to beat?
We're doing our first one, I think, next month, so I can't add to this.
I'm not quite sure how valuable employee NPS is. What we do is we do quarterly pulse surveys. So what that looks like is you send out an employee survey and you track multiple different metrics, right? And so it could be there are some employee satisfaction things, but a little bit more fine-grained than that. Like, do you feel like you work in an inclusive culture? Do you feel like you are owning decisions? Do you feel like you're empowered to make your own decisions, things like that, right? So I think NPS, why it's a helpful guideline for customers and things like that. At an employee level, I think usually you need to be a little bit more fine-grained. We actually use an awesome product out of Australia, CultureAmp. Thank you. That's actually phenomenal. So we've been using that for a couple of years, and it allows you to kind of track. You can also check benchmarks to see kind of in some of these standardized questions how you compare to competition, stuff like that. So that's what we've used in the past.
So I have two questions. One of them was for Brex, and another one was for Pagarmi. So for the Brex, what is the inter-exchange fee for the merchants? And for the Pagarmi, so how you partner with the banks? For example, in US, Wells Fargo require you to have transact at least $6 million to partner with them so they can give you master merchant accounts so you can provide something like Pagarmi or Stripe. So how you handled it in the Pagarmi?
So two separate questions. On Brex, what is the interchange fee? Is that your question?
Yeah, interchange fees for merchants.
Yeah, so the way interchange works, and first, interchange is the fee that whoever the card issuer is, which is in Brex or American Express or Chase, how much they keep. Interchange varies according to what are you spending on. So if you're spending on, for example, I think it's like donations, it's I think very low, like 30 basis points or something like that, 0.3%. Or if you're doing an Uber, I think it averages out to 3% or something like that. I don't exactly know the numbers, but it varies, and the average depends a lot on, who are your customers. If your customers are a lot of people who are, just using it for donations, it's very low. If your customers are, doing a lot of, Uber spend, it's very high. So it depends a lot. It's not a fixed thing because it changes by merchant, if that makes sense. On the second question is how you do it. So what we did was that every time a customer signed up, we went on the phone and called the bank and set up a regular account for them, and they didn't know it was the bank in the back end. So we just had, a bunch of people calling and setting up accounts until we hit the minimum limit to be able to be the master merchant under them.
What else?
Is this a microphone then? Is that how it works? This is for Jules. I'm David with Ninth Gear Technologies. You said 109 IPOs. Very impressive. tell us about how many companies are littered on the highway that it took for failures to get to 109 IPOs.
We cheat because we just start at the late stage, so we don't start at the seed stage. Otherwise, there wouldn't be a very lot of litter. No, so we've backed since 1980 over 400 companies, and we've had 109 of them go public. A lot of companies exit through M&A. That's still like the most likely exit. The good thing is at our stage, very few companies go completely out of business. We've only had a few complete write-offs in the last 20 years, but that can happen. They're really painful, especially at the late stage. But most of the companies they're already at, there's some IP or asset there, but it's hard. Like all the companies we invest in are great on the way in. Otherwise, we wouldn't invest. But there's this business. Often, you're wrong not investing in the companies that perform well, and sometimes you're wrong thinking this company is going to be a lot bigger company, and it doesn't turn out to be. Often we're wrong about like market size and timing, and that's why to this discussion around the second product, a company that's got the ability to evolve and get better is I think really important. One of my favorite investments is a company Yext. I invested in my second investment at IVP in 2009. They almost went completely out of business. They did a pivot from a advertising business to a SaaS product based in New York, and now they're a multi-billion-dollar public company in New York. But 2 or 3 years in, I would have thought it would have been one of our toughest investments, and ended up turning into one of our best. So it's pretty tough, and this business seems almost more random the longer you do it.
And then can you bring it up here?
Hi, this is for Brex. So I'm a customer and pretty happy with all the rewards that you guys are offering. I was wondering, are you guys covering the cost out of your pocket, or did you have like exclusive deals from these rewards providers?
So the points, we cover it out of pocket from the revenue we make from the customers. And the deals, most of them is merchant funded. So whoever is giving the deals, like Guideline or Amazon, they're funding most of it.
Yes, it's for Henrique. How do you compare with a company that's doing something similar in Brazil, like Nubank? You monitor them? Do you compare?
So they're serving consumers, we're serving businesses.
Let's take it over here.
Big throw. Oh. Good thing it's foam on that thing. You guys in that company?
No, we didn't.
Hey, I'm a Brex user as well, probably one of the earliest ones. We met at a couple of parties before. So my startup was recently acquired. Part of my startup was acquired. Now at Lazard, which is an investment bank. Many people would know in the financial space. My question is 2 separate questions. First one for Brex. You talked about balance sheet risk and why you need to raise more capital up front. How do you see Google and Amazon, who have crazy large balance sheets, do you see them as competitors, especially given Amazon has its own lending program for merchants, or do you not view them as competitors? They're not a threat. And the second bit is for Plaid. We're big user of Plaid. I'll follow up on that post this. How do you see the regulatory landscape impacting the individual developers that build off of your platform? Because you're essentially now a hub for developers to take the spending data of people in their bank accounts, or whatever financial data exists. So how do you see the regulatory landscape evolving, if at all you see it evolving?
I'll start. Sorry, I'm thinking. Do you want to start? I'm thinking about the answer.
Yeah, sure. Well, first off, thank you for being a Plaid customer and a Brex customer. It's a complicated question, and so I think for us, how we try to take something like regulation is it can be a negative, right? It can incur expenses for us and all of our clients, and make law firms a lot of money. Or for us, can you make it into a product? Can you make it into an asset? And so a lot of times, what we focus on is how do we actually try to take most of that regulatory pressure on ourselves. And so if you think about our assets product, a big reason that why we actually launched the assets product was so our customers wouldn't have to become credit reporting agencies, right? And so can we actually use a regulation to kind of take most of the brunt on the force of ourselves and take that off the backs of our clients? And so there's actually an advantage using Plaid. It's like, if you use Plaid, you don't have to worry about conforming to these regulations because we're going to handle that for you. So for us, it's mostly focused on the products and how do you actually make it easier for people to start businesses. As you start to go international, it starts to become a little bit more complicated because they have a little bit stricter regulatory regimes. But for us, it hasn't been too big of an issue yet.
So the way we think about, you asked if competitors who think of Google, Facebook have large balance sheets. So historically, companies that were not in credit don't like getting into credit because their multiples in the public markets start going down once they go into credit. So we've seen, for example, a big movement. PayPal had this huge credit portfolio and sold it to Synchrony, I think a year ago or something like that. And the reason for that is because, as a public company, your multiples are much better if you don't have the risk of a recession, having a bunch of losses. So that's why you see more things like, for example, Amazon partnered with American Express to issue their, I think their credit card for small businesses. So for us, we end up seeing, more the banks and American Express and like all those guys as the main competitors, maybe partnering with distribution channels like Amazon and Facebook and Google over time. But because they're so clean revenue and so clean profits and they have such great multiples, going into credit is usually like a poor strategy for them.
Back there.
Oh, that's pretty smooth. That's good.
The question's for Henrique. Do you guys experience churning?
So startups die a lot. By that definition, yes, all the time. So we measure involuntary churn and voluntary churn, and it's kind of hard for us to know a little bit. So the way we measure it more is around just retention. So from the people that sign up, how many keep using on the cohorts, and we also measure net volume churn, which is some people spend more every month and some people spend less every month. And we try to not to get caught up too much on the, in each individual one, but looking at the net one.
Sorry, maybe I meant like churning as the kind of illegal accumulation of points through like, it's kind of the, how do I explain it? It's like you illegally spend on your credit card to acquire the points, but you actually don't spend the money. So they don't leave your account.
Yeah. In our industry, we call that breakage. That's the technical term. So the thing for us is, a lot of people, we book all the points that we give people, we book it as an expense the month of. So for us, if everyone used all their points in the city, in the same month, that's kind of how our financials look like. Turns out a bunch of people, don't use their points over time, but we don't do that. We don't try to like measure that and optimize that because that's what banks do. Banks, what they do is that, we make a lot of money when people don't use their points. Like make it really, really hard for them to use their points, right? Because then they're going to be making a lot of money. And we think that's a bad thing because imagine 2 years from now, we have a product manager optimizing not redemption of points, And that's kind of like your product starts to suck. So we actually try to do the opposite. We have a lot of actions to get people to use their points more because we believe that once you use your points, you have a really good experience of Brex and you feel that we generated value to you and you're going to be a better customer for us over time.
So you guys have talked a little bit about marketing and a lot about product. Can you talk a little bit about sales? Because in the Valley, we hear a lot about product market fit, but very few people talk about product marketing sales fit. And especially in the B2B space, sales is very important. So how do you guys think about sales? And Jules, you as well, from a VC perspective, when you look at your companies who tend to be typically enterprise startups or B2B startups, what advice do you give them or what actions do you see them taking as far as sales is concerned and building a sales engine?
You want me to start? So we love sales and marketing. I think, a lot of people, a lot of companies in Silicon Valley take pride on like, hey, I spent zero on marketing or, I don't have salespeople. It's all self-service. our product supports a model of having sales, and it only accelerated us. And, so we have a lot of people selling, and we're growing that sales force, and we're growing really fast because of it. But that's because our economics support that. In that, I personally, have a special place for sales because, my co-founder, you code better than I do. So when we were starting our first company, he was like, Henrique, you're not going to touch my code anymore. So he sent me to do the rest, and the rest, was sales. And so I ran Pagarm in my last company, Salesforce, for a long time. And, and I think it's this thing where you can actually go over a bunch of objections, and you can actually make customers that wouldn't naturally sign up for your product sign up. And that doesn't mean you don't have product market fit. It just means sometimes, you need to make it a priority. You need to create urgency. There's all these effects that sales can create that are different than product marketing that, I think can really accelerate your business if you support it.
I 100% agree with that. I think there is I definitely I'm guilty of it. There in Silicon Valley, we tend to overplay the concept of engineering product and downplay sales. Engineering product is sure, it helps you get over the hump to get to product market fit. And after that, it's all sales and marketing, I think in many ways. I should figure out how to plaster billboards in San Francisco and make a lot of money. And the fact that we haven't done that isn't because I don't think that works. It's because I don't know how to do that yet. And so I think it's very much a fault of our own. And in the end, Henrique and I probably haven't pushed code in a while, right? We're both technical, but in the end, everything is sales. I just spend most of my time selling candidates, right? They're just higher priced, little bit more fickle customers. And I'm sure Henrique does as well, right? We spend a lot of time selling banks to make sure that they like me. Internally, right? You sell employees to make sure that they are happy. In the end, everything after you find product market fit to an extent is sales. It just may not look exactly like sales if you think about it.
I feel like I have to be the VC putting a plug in for product and engineering. So with two engineers on the side of me, but no, I think product and engineering is kind of like the car. It's like the engine or the car, right? And the sales can be the driver of the car. If you don't have a good car though, and you're doing Formula One with an old jalopy or something, you're not, it doesn't matter how good the salesperson is, that's not going to be very successful. So I think both these companies have amazing engines. And so, both can benefit from a great driver and from sales. But ultimately, I just think it all starts with the product and engineering. And there's very few companies that have terrible products, but the great sales just kind of got them through. That I think it really starts with the product more and more.
And the big guys are pretty good at sales, actually. They're not great at, engineering and product. They're pretty good at sales. So if there's a big incumbent there, it's really hard to compete just with sales. So you need, as Jules said, a really good car. But then sales and marketing can be a big accelerator. And, the money can be the gas.
Looks like there's still a lot of questions, so let's have just one of you guys answer for a few, and then we can try to get through a bunch.
Do you mind if we go to someone who hasn't answered a question? Is that okay?
What?
All right.
Yes, not everyone's asked a question.
Sorry, since you started down the sales train, how do you get, when you're early on, let's say you're a technical product, through some of the big whale customers that have either long procurement processes or very high barriers of entry?
Through the best one you sell.
So enterprise sales models when you're starting out.
So when we started, we purposely didn't sell to enterprises because we didn't know how to do that yet. I do think selling to large enterprises that have more than 6 months, longer than 6 months, it's so expensive. You have to be really, really good at it. And early on, we just weren't. And so we sold to people who we knew their buying habits, which was other startups. And then after that, you have to have enough money or revenue to be okay with a 6, 12, 18-month sales cycle, and then support everything that comes with that, from a compliance program to a legal program to anything like that. And for that, you just hire really good people. I just hired a lot of people that were better than myself.
A question for Henrique. So this talk is about building your products. Would you rather expand internationally, staying B2B, or would you stay in the US and building maybe a B2C solution?
So B2C, definitely not. We're not going there. I think that, the question for us is always do more verticals and, and go to other types of businesses, or do the verticals we're already doing in other countries. I think it's a balance. For now, we decided to do more verticals in the US just because this market is so big. So a good example is like Square is like a $30 billion company, and I don't think they have barely any presence outside, and the biggest competitor outside of the US is probably I don't know, SumUp or something that's like a $3 billion company. So it's not that there's not opportunity outside, but the US is so big that the risk of losing focus is not, at least for now, for us, is not worth it.
Okay. So I have the two questions again. One of them is about limitation as a student. You came to US as a student, right? So there is a weird limitation that as a student you can't work even in your own startup. So how you get around that? And the second question was about, again, Army. Okay, so you call the banks and manually open merchant accounts, but you kind of have to charge those merchants somehow. So how you did that? Did you link did you collect all the funds?
So the second one, we just invoice them separately.
Oh,
so we send them an invoice at the end of the month. For the first one is we got a green card since we got in the US while we were still students, so it wasn't an issue. But we're deeply knowledgeable of all types of visas because we support international a lot in all the countries. So happy to chat after what's the best visa things we found for students.
We need some location diversity of questions, so it's hard with the box because it's right here. But is anyone far away from the box want to ask a question?
Or maybe that's standing up because
or just like far away and. Or
so,
that can't be reached by.
Yeah, this is a question. This is a question for Henrique. So when you first started Brex, obviously you just started with a couple of you guys are the co-founders. You had zero history of credit, but how did you start up the process in terms of reaching out to banks? How did you decide which bank to work with, and essentially ultimately help you set up a corporate card so you can start doing business?
So for us, we used a company called Marqeta in the beginning. That is like a fintech that, in some ways similar to Plaid, is enabling a lot of fintechs to start out, and that's kind of how we started. And in parallel, we then used our investor network to reach out to banks that could do this partnership with us, and we talked to a lot of banks and landed on a few that wanted to work with us, and and then we ended up doing direct connection to the bank deal.
Great, thank you.
Hello. All right. Thank you for having us. First of all, question, of course, for Henrique. You mentioned American Express a few times, and
what?
You mentioned American Express a few times,
Yeah.
and it would be like a good goal to kind of compete against them. Now, I know American Express, besides all the other ways they can make money, they do charge a yearly fee, and like every other credit card company, they rely on, let's say you, even though they're a charged card, if you are late, they can charge you percentage-wise to make more money out of how much you owe them. I know for Brex, you guys are a charge card, but if someone doesn't pay, I believe you guys cancel the card from the first one. So to get more benefits for the consumers or for the users, that means you have to make more money. Are there plans to, let's say, provide more other types of credit cards, more ways to make more money?
So it's always a big question for us. Is like, hey, we can make a lot more money by lending. The thing about our business is that, at the end of the day, we're lending money to companies for 30 days, right? And we have to think about how to not lose money, because it's like this existential risk for us. And the thing about providing a card that doesn't have the functionality of lending is that everyone that needs the money, we're a bad product for them. So it's kind of like this natural selection of companies that have other ways to finance themselves, and by the way, need us as a card, instead of companies that are using us as their main source of financing. So we definitely don't want to replace your VC, that's his job. But so not having the lending functionality kind of forces the company to grow just with customers that are, more financially advanced, which is our focus to date.
All right, last question.
Hi, this is a question for Henrique. How did you get banks comfortable in the beginning to underwrite risky companies or startups?
That's went to the raising money part. We had raised, a decent amount of money, and then we said, we'll pay for all the defaults, and we'll keep reserves in you, and like worst case scenario, just take those reserves. So we basically use the fundraising to reduce risk for them.
Thank you.
Cool.
All right, yeah, thanks guys.
Awesome, thank you.
Guys, thank you so much.
Hey, thanks, man.
Excited to meet your wife.
Oh, honestly, yeah, you should. Get it. Did you have hair, right? From there, right? No, I have art. Here's art. Yeah. Am I going? Where are we going? But we punch way beyond that. You have a fanboys in there. We also doing some stuff in venture debt. So if you have anything, yeah, sounds good. And I don't know where you guys are based. I'm in the city. We have offices in parts. They don't have the West Coast stuff. You have like, you used to stand for